How to estimate what an income property is really worth. Whether you're a buyer or seller or a mortgage lender, one of the most important questions you need to answer is, what is the property really worth? It may be argued that value, like beauty, is in the eye of the beholder. These arguments tend to ring true in regard to single family homes, where conventional wisdom has always held that a house is worth what somebody is willing to pay for it. Income producing property, however, is different. Value is determined by the numbers. The owner of the Yankees may admire a batter's graceful swing, but he pays for what the batter's betting average is. Let's begin this discussion with a subject that always warms your heart: income. Everyone in business or finances has encountered the term net income and understand its general meaning. What is left over after expenses from the revenue. With regard to investment, real estate, however, the term net operating income (NOI) represents a minor variation on this theme and has very specific meaning. You might think of NOI as the number of rands a property returns in a given year if a property is purchased for all cash and there is no consideration of income taxes or depreciation. By a more formal definition, it is a property's gross operating income less the sum of all operating expenses. You saw these terms in Chapter 2, but they're critical to understanding of virtually everything that follows. Let's review them briefly. Gross operating income. The definition are like artichokes. You need to peel off the layers one at a time. In this case, starts off with gross scheduled income, which is the property's annual income if all the space were in fact rented and all the rent actually collected. Subtract this from the amount of allowance for vacancies and credit loss. The result is gross operating income. Gross scheduled income vacancy plus credit loss equals to gross operating income. Gross scheduled income less vacancy and credit loss equals to gross operating income. Operating expenses. This is the term that causes the greatest mischief. Many people say, if I have to pay it, then it's an operating expense. That is not always true. To be considered a real estate operating expense, an item must be necessary to maintain a piece of property and to ensure its ability to continue to produce income. Loan payments, depreciation, and capital expenditures are not considered operating expenses. For examples, utility supplies, snow removal, and property management are all operating expenses. Repairs and maintenance are operating expenses, but improvements and additions are not. They are capital expenditures. Property tax is an operating expense, but your personal income tax liability generated by owning the property is not. Your mortgage interest may be a deductible expense, but it's not an operating expense. You may need a mortgage to afford the property, but not to operate it. Subtract the operating expenses from the gross operating income, and you have NOI, net operating income. Gross operating income less operating expenses is equal to net operating income, NOI. Now, why all the nitpicking? Because NOI is essential to understanding the market value of a piece of income producing real estate. That market value is a function of the property's income stream, and NOI is at the core of that income stream. As unfeeling as it may sound, a real estate investment is not a handsome assemblage of bricks, boards, and cables and bathroom fixtures. It is an income stream gathered by the operation of the property. Independent of external factors such as financing and income taxes, investors don't decide to buy properties, they decide to buy income streams of the properties. This is not such a radical notion. When was the last time you chose a stock based on aesthetics of the stock certificate? Never you buy, never. You buy the anticipated economic benefits. The same is true of investors of income producing real estate. Those readers who have not yet been jeweled to sleep by this discussion will allegedly point out that they have in fact observed changes in the value of income property brought by the changes in market interest rates and in tax laws. Doesn't that observation contradict our assertion about external factors? If you're familiar with the concept of capitalization rates, you recognize that there are two elements to a property's value equation: NOI and cap rate. The NOI represents a return on the purchase of the property, and cap rate is a rate of that return. Hence, a property with a 1 million rand purchase price and 100,000 rand NOI has a 10% capitalization rate. However, the investor will purchase that property for 1 million rand only if he judges 10% to be a satisfactory rate of return. What happens if interest rates go up? In that case, there may be other opportunities competing for the investor's capital. Bonds, for example, and the investor may now be interested in the same piece of real property only if its return is higher than say 12%. Apply the 12% cap rate. Present value is equal to net operating income divided by the cap rate. And now the investor is willing to pay an amount of 833,000 rand. External circumstances have not affected the operation of the property or NOI. They have affected the rate of return, the so-called market cap rate that the buyer will demand, and it is that change that impacts the market value of the property. In short, the NOI expresses an objective measure of the property's income stream, while acquired capitalization rate is the investor's subjective estimate of how well his or her capital must perform. The former is mostly science, subject to the definition and formula, while the latter is largely art, affected by factors outside of the property, such as market conditions and tax policies. The two work together to give you an estimate of market value. Now, cash flow and taxable income. So far, our discussion on the meaning of NOI, what it includes and what it does not include, and what significance it has on your understanding of the worth of an income property. As the figure below shows, the topic of cash flow and taxable income are natural extensions of NOI. Net operating income, there's the interest paid, the depreciation, amortization, and the interest earned. There's the debt service, there's the capital expenditure, and then there's the interest earned. When you look back at a year of operating your property, a reasonable question for you to ask is, how much did I make this year? The answer lies in a review of the property's cash flow and taxable income. NOI is starting point of our discussion here. Once you know the property's NOI, you branch off in one direction to figure its taxable income and in another to figure its cash flow. You'll see shortly, these branches eventually reconnect to give you your true bottom line. Let's first look at these two branches and how they differ. Taxable income or loss. Both branches start with NOI. Remember that mortgage payments play no part in NOI calculation. So it is now below the NOI line. That is, you will last take financing into account. When you make your taxable income calculation, you can deduct only the interest portion of the loan payments. Likewise, if you earn interest, you must add it back into your income. You also make deductions for depreciation and amortization. When you purchase a piece of investment real estate, you can't just deal with its full cost immediately as an investment expense. Instead, you can deduct each portion of the value of the depreciable asset until you finally written off the entire amount. With real estate, you are allowed to treat the physical structures as depreciable assets for tax purposes, but not the land. An editorial aside, the author, having learned the commercial real estate business in the prehistoric age, still uses the term depreciation in the modern age of unrelating political correctness. You'll frequently find the same concept referred to as cost recovery, blah 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 blah. At the writing, you can depreciate a residential income property over 27.5 years and a non-residential property over 39 years. Since not everyone buys or sells on the first month, the code tries to even matters out with so-called half-month convention, which allows taxpayer to claim only half the normal amount of depreciation in a month that the property is placed in service and half in a month when it's sold. Of course, the authors of the tax code should have made matters more precise by simply asking you to prorate your partial month of depreciation, just as your bank does with your per diem mortgage interest when you buy and sell. But no, they didn't. Another term that affects your taxable income is amortization. It is important to understand the term as used here does not refer to the principal portion of the loan payment. Instead, it refers to the process of taking a partial annual tax deduction for an item you're not allowed to expense in a single year. A good example of a cost that must be amortized is the premium you pay for securing a loan, commonly called points. You typically pay a premium in one lump sum or the day you close a loan. You must amortize it over the life of the loan. So if you take out a 240-month investment property loan of 720,000 that requires 2 points of 14,400, which is 2%, you can deduct 60 rand per month or 720 for each full tax year. You may earn some interest income on the property bank accounts or on escrow account that your lender may require for the real estate taxes and insurance. To review your taxable income as your NOI less interest payments, less allowable write-offs for depreciation and amortization, plus any interest earned. Net operating income, the interest paid, less depreciation and amortization plus the interest earned equals to taxable income or loss. Cash flow before taxes. Cash flow is even more straightforward. As you suggested in the introduction, think of it as it's your property's checkbook. It is everything that comes in less than everything that goes out in terms of cash. By starting with NOI, you have already accounted for all the rent, revenue, credit losses, and operating expenses. Where else do you spend or receive money? You made mortgage payments and now you can count the entire payment amount. You may also make capital improvements to a property. An improvement prolongs the life of a property. It's different from repair, which maintains rather than increases that life expectancy. The cost of improvements affects your cash flow as soon as you spend the money, even though you may typically have to write it off over 27 to 39 years. Again, here you earn interest income on your property bank accounts, which also adds to the cash flows. The short version of our discussion now boils down to this. To derive the property's taxable income, you take the NOI, subtract everything that a property's tax is deductible, and add a non-rental income such as interest. To calculate its cash flows, you take its NOI and then subtract everything that actually spent but not already accounted for in the NOI computation itself. Again, add any non-rental receipts. NOI less debt service, less capital expenditures plus interest earned, it's cash flow before taxes. Cash flow and taxable income are closely related, but still have important differences. Cash flow is real. Money comes in, money goes out. You earnestly hope the difference will always be a positive number, and if it is, you can take it with you and you can even spend it. With all due respect to the considerable industry that is built around tax planning and preparation, taxable income is not quite so real. In whatever the tax code it says, if tomorrow the parliament should decide the useful life of commercial real estate used to be 100 years instead of 39 years, then your property's taxable income will rise without you experiencing a single additional rand in rental income. Why? Because the write-off period would mean a smaller annual deductions for depreciation, and fewer deductions means higher taxable income, despite the fact that your gross net income remains unchanged. Likewise, if mortgage interests are no longer deductible, the effect on mortgage payment on your cash flow would remain unchanged, but the effect of the loss deduction would be to increase your taxable income and hence your taxes. Cash flow after taxes. All this talk of deductions brings you to the fulfillment of an earlier promise to reconnect the branches of your diagram. Up until now, you have been discussing cash flow before taxes (CFBT), but more meaningful bottom line to you as an investor may be cash flow after taxes (CFAT). Taxable income or loss times the tax bracket equals to income tax less income tax, which leads to cash flow after taxes. While taxable income is somewhat artificial notion, the tax liability it provokes feels very real indeed. Taxable income creates one last cash flow item, income tax, which must be subtracted from the CFBT cash flow before taxes to give you your bottom line cash flow after taxes. Again, recall our discussion in the introduction in the 4 ways to make money in real estate. Your taxable income may be negative as well as positive. If it is negative, then it may actually result in a negative tax liability and it can increase your CFAT by sheltering other earnings. Now here's a case study. A comprehensive example. It demonstrates how all the numbers interact. For readability, let's make projections that go out just 5 years. If you would like to work out any of the calculations by longhand, you'll find forms for taxable income and cash flow in the respective chapters in part 2. In this analysis, you plan to acquire a small strip shopping center for 1.2 million rand. Your cavalier attitude toward debt leads you to take on 3 mortgages. The first mortgage is 720,000 Rand at 8% interest rate over 20 years. You must pay 2 points, 14,400 to secure the loan. The second mortgage is 10-year note of 100,000 Rand at a fixed interest rate of 9%, and it also requires 2 points of 2,000 Rand. The third loan is from a seller of 10,000 Rand at an interest rate of 10%, fixed and due to mature in 10 years. It requires a single interest payment annually until then. For purposes of calculating depreciation, you look at the municipal tax assessments for the land and the building, and you conclude that 72% of the property's value lies in the building and the remainder in the land. Therefore, you judge reasonably that the amount that can be depreciated is 72% of the 1.25 million purchase price, or 900,000. The property has an annual gross scheduled income of 208,000 Rand and annual operating expenses of 14,900 for the first year of projections. You expect both income and expenses to increase at 2% per year. You leave an allowance of 3% for possible vacancy and credit loss. Sorry to get personal, but we need to know your marginal tax bracket. You whisper it to us discreetly, but we publish it for the world to see with this 28%. You can now begin to sort out all this information. What is the NOI for years 1 to 5? In the first year, your property gross scheduled income is 208,200. From that amount, you subtract 3% allowance for vacancy and credit loss to get the gross operating income. Next, you subtract 40,900 in operating expense to find the first year NOI of 161,054. To calculate the NOI for the next 4 years, you first need to increase the gross scheduled income by 2% a year. Once you have done so, you can then compute the vacancy and credit allowance, which is 3% of the year's scheduled gross. After that, figure out the operating expenses by taking the first year amount of 14,900 and increasing it 2% per year. Finally, subtract the expenses from the gross operating income to get your NOI. Now here is that schedule for year 1, year 2, year 3, year 4, year 5. All that was easier to do than to say. Now from NOI, you can follow the first branch of our diagram, which calculates the taxable income. Before you do the math, look at the more detailed representation of that branch. Net operating income less interest of the first mortgage less interest of the second mortgage, less interest of the third mortgage, less depreciation, real property, amortization of points, less amortization of the second mortgage, less amortization of the third mortgage. Now the interest earned on taxable income. From your NOI, you subtract anything that is tax deductible. Mortgage interest falls into the category, so you subtract the interest from each of the three mortgages. Depreciation, even though it's not cash out of pocket, is also deductible. Similarly, you can deduct a portion of your points you paid to obtain each mortgage. If you had an income that was not from rent, typically interest earned in the property's bank or escrow accounts, that interest needs to be added in as additional income. Now, here's a shameless self promotion. You can go back to the website, the original website of realdata.com, where you can purchase software and perform calculations like these. Now let's look at the same list of the amounts calculated and filled in. You have the NOI, which was from the previous figure of year 1, year 2, year 3, year 4, year 5, and you do all the calculations and until you get to the tax income for each specific year from year 1 to year 5. In regard to the mortgage interest paid out each year, there are several ways to calculate the amount manually or with Excel. You can download an amortization schedule to create a table that will show you monthly or annual principal and interest. However, that one of the mortgages is not amortized. The third mortgage is the transaction, is interest only paid annually. Cash flow will increase every year. Net operating income, including minusing all the mortgage payments for each of the three mortgages, less capital additions, plus the interest earned equals the cash flow before taxes from year 1 to year 5. To arrive at your final result, you must eliminate your tax income liability to determine your cash flow after tax. Although the calculation of potential income tax liability can involve complexities such as passive loss limitations and suspended losses, this case study maintains a straightforward approach as demonstrated in Figure 4.4. Refer back to the taxable income calculation in the previous table to retrieve the year 1 taxable income of 71,231. From this figure, calculate the income tax liability attributed to the owner of the property. Multiply the taxable income of 71,000 by a marginal tax bracket of 28% for an estimated tax liability of 19,945. In summary, achieving your projected cash flow before taxes of 72,000 will result in a tax liability of 19,944, leaving you with a cash flow after tax of 52,640. That's for year 1, 54,705 for year 2, 56,502 for year 3, 58,297 for year 4, 60,086 for year 5. It's noteworthy that you anticipate paying more taxes each year as the property earns more tax income annually. However, since the cash flow before taxes is growing fast at a faster rate than your tax liability, your bottom line of the cash flow after taxes increases each year. Without positive cash flow, your property becomes akin to a plant in a little shop of horrors, constantly demanding feed me at every turn. Positive cash flow is crucial for all investors and indispensable for some. Does the cash flow after taxes mark conclusion of your ongoing investment analysis saga? Not all. Next, delve into the ultimate resale of your property and how its value impact of your overall investment quality. Resale and how to forecast the appreciation potential of a property. While net operating income, taxable income, and cash flow has been discussed, resale is a topic that sometimes receives less attention from novice real estate investors. Some may dismiss resale as speculation, while others find it challenging to seriously consider selling a property they haven't yet purchased. Incorporating a contemplation of resale into your investment mindset may require extra discipline. But such discipline often distinguishes successful investors from others. Evaluating your property's worth is such a crucial as assessing its value on the day of purchase. You care about potential cash flow, financing, operating costs, and tax benefits. Equally important is whether the property will be sellable after acquisition. Recite this mantra when considering income property. If it's not worth selling, then it's not worth buying. While the world may not be perfect, assuming a level playing field is reasonable. If you would scrutinize a property's income, expenses, finances, and returns before buying, expect investors to do the same. When you decide to sell, it pays to forecast future numbers today and understand how investments will appeal to a future buyer. What are the numbers that should concern you when analyzing a potential resale of an income property? The most obvious is the selling price. You can estimate the property's value in the future by applying a reasonable capitalization rate to the net operating income. To do this, estimate the property's NOI of the year of sale and the capitalization rate that the buyer would expect. The NOI is the return amount and the cap rate is the rate of return. For instance, if the market expects a 10% return on your property as an NOI of $12,000, the estimated selling price will be $120,000. Buyers and sellers may interpret the same information differently, making process akin to poetry in commercial real estate. Sellers may estimate a value based on next year's expected NOI, while buyers may capitalize on current year's income stream. Understanding the difference is perspective is crucial. Once you estimate the resale price, the rest of the analysis is relatively straightforward. Calculate the estimated tax liability at the time of the sale, and with that number, forecast the proceeds of the overall return for the holding period. Revisit the property in the case study to estimate its value to a new buyer, and if the cash proceeds you might expect from a sale of the buyer, assuming that the seller of the property at the end of the 5 years start with an estimate of its selling price by capitalizing its NOI. Be conservative and assuming investors will expect a higher cap rate. Given the NOI of 174,330 in year 5, if investors expect a 12% cap rate, estimate the property selling price as follows. NOI value is equal to NOI times the cap rate, which is 174,000, no, 1.74 million, which is times the cap rate, which is equal to 1.452750. After estimating the selling price, deduct cost of sale, mortgage offs, and other expenses to calculate before tax sale proceeds. Subtract these from the projected selling price to determine the cash you might receive from closing. Projected selling price less cost of sale, less cost first mortgage payoffs, second mortgage payoffs, third mortgage payoffs is less the before tax sale proceeds. Typically, a cost estimate as 7% of the selling price, covering legal and brokerage costs. Fill in the numbers to determine the cash remaining after debts and expenses. Finally, compare this amount with your initial cash investment, considering the property purchase, loan points, and the balance as your cash investment, with an initial investment of 436,000 positive cash flows and closing check for over 650,000 before taxes. The investment appears promising. When it comes to taxes, the rules for real estate sales are moderately complex and subject to change. For general understanding, calculate the gain on the sale by subtracting the adjusted basis from the selling price. The adjusted basis of the property's original costs plus capital improvements plus closing costs and other sale related expenses, less accumulated depreciation. For the property in the case study, assume you can take only one half This aspect of the computation has weathered numerous alterations in the tax code, indicating that its likely persistence or foreseeable future. Nevertheless, one should refrain from relying on the permanence of tax regulations. Please note that the calculations in the following sections are presented more for illustrative purposes than explicit guidance. When determining your tax liability upon the property sale, specific deductions may come into play. For instance, if you experience operating losses in previous years that surpassed your passive loss allowance, which prevented their deduction earlier, you can now deduct them during the sale. Additionally, if you have been amortizing loan points and leasing commissions and there's an unamortized balance on these items, you can deduct it upon selling. In this case, your sample property, there are outstanding points yet to be fully written off. Recall the 16,400 Rand paid to secure the first and second mortgages. You have been amortizing 720 Rand of the first mortgage and 200 Rand of the second mortgage annually. Over 5 years, you've deducted a total of 920 Rand each year, amounting to 4,600. When the full points of 16,400 and 4,600 are already amortized, there's 11,000 left to deduct, 11,800. This amount can be added to the deduction for the fifth year, considering the property's sale is retiring the loan. With this information, you can now calculate the tax liability due upon sale. Current rulers, as taxpayer in 28% bracket, you would split your 214,752 gain in two parts, an amount equivalent to the depreciation taken and the remainder. The gain divided into 113,462 tax at 25% and 102,290 tax at capital gains rate. Don't forget that you still have amortized points of 11,800 you can deduct at an ordinary income rate. If it seems intricate, you are not alone. Follow our earlier suggestion and consult with your accountant when the complexity increases. The conclusion the inclusion of this information here aims to complete the circle and reveal your ultimate bottom line at the time of sale, the after-tax sale proceeds. In this chapter, you've gained a comprehensive understanding of the property's true value in terms of cash flow and eventual sale proceeds. Now it's time to yield your yardstick and learn how to gauge the quality of the real estate